You're about to hear my conversation with Phil Toller, Senior Vice President, Portfolio Manager, and lead of the growth team at Mackenzie Investments, who specializes in small and mid-cap U.S. equities. You'll hear us talk about the impact of tariffs, as well as the potential tailwinds of deregulation and corporate tax cuts in the small and mid-cap space, the investment philosophy and process utilized by Phil and the team, as well as some really interesting AI use cases they've recently come across. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction and Mackenzie Private Wealth. You're about to hear my conversation with Phil Toller, who is lead of the growth team at Mackenzie Investments with a specialization in small and mid-cap U.S. equities. Phil, thanks for joining the podcast this morning.
Well, thanks for having me.
I want to get right into the questions because I've got a lot for you today, just given the environment that we're in. And I think a good place to start is going to be an obvious one. We're early 2025. We're starting to see the impact of rising trade barriers and tariffs, at least from an investor sentiment perspective. But from your perspective, as a portfolio manager who speaks to management teams at companies, what's your view on how this will play out with these companies? And I'm really just trying to glean, what are you hearing right now?
Well, a couple of weeks ago, we were at a conference where we saw a lot of companies. There's a lot of confusion because the final rules aren't set yet. That being said, a lot of our companies have a lot of intellectual property in their products and services. And so that gives them some pricing power above and beyond the cost of raw materials. Many of them don't use any raw materials because what they produce is a service or a piece of software. But even those that do make some hardware have a lot of intellectual property in that, and therefore believe that they can navigate this period relatively well.
Okay, that's interesting. So investors are a little shaky because they don't have the details, but it sounds like even for the management teams at these companies, they're still waiting for the details as well, as are you and your team as portfolio managers. So maybe we'll stay with the priorities of the current U.S. administration and Congress. Two of the themes that we heard in the election last year were deregulation and potential corporate tax cuts from a Trump administration. I'm curious if those two priorities do come to fruition from the current administration. What would be the impact on the space you specialize in, which is specifically U.S. small and mid-cap companies?
Glad you brought that up because, right now we are facing the volatility of the uncertainty around tariffs and trade barriers, which is fair enough. Markets don't like uncertainty, but there's more good things perhaps to come down the road, and corporate tax and deregulation would be positives, I think, for most of the companies in our space. On the taxation side, a lot of our companies are not, some of them are, but many of them are not global because they're not that big. So most of them pay a pretty full tax rate in the US, and a lower tax rate would therefore benefit them very much. On the regulatory side, less regulation at the margin is less onerous for a smaller company because it's more burdensome given their smaller scale than the bigger guys. So it's a benefit there, and perhaps that might generate some higher mergers and acquisitions activity, although we haven't seen that yet. But particularly for small companies, that might be of interest. And as large companies look to grow in a tough world, that is one way to grow a bigger company. So some of our companies might hopefully become targets down the road.
Interesting. Now, Phil, I'm not an expert on the Canadian tax code, let alone the US tax code, but is it fair to say small mid caps vis-a-vis their large cap peers are more likely to benefit on a relative basis, at least with regards to potential corporate tax cuts?
I think that's probably true for many of them. For some of them are global, even though they're small. So it depends. But on the whole, on a relative basis, I would say the smaller companies are more benefited by a lower US tax rate because they don't have that global tax planning opportunity that the big companies have.
Okay. Thank you. And another follow-up question, just staying on regulation. Earlier in the year, from a sector basis, at least in the large cap space, we saw a number of names in the financial services sector benefit, oil services, and the thesis was that there would be most likely to benefit from potential deregulation, although we haven't seen any specifics come out just yet. I'm just curious, for the universe that you look at, are there particular GIC sectors or industry groups that you think are more likely to benefit from others, or is it just too early?
So it's a little early, but one of the things that this administration is trying to prioritize is reshoring and nearshoring of manufacturing capacity to the U.S. And so we're involved, getting involved a little more in companies that might benefit from that, and on some of the hardware for manufacturing, or perhaps some of the infrastructure plays that we're getting interested in.
Okay. Excellent. So, Phil, I want to focus in on the US and small cap space. It's a very different market from the Canadian small or mid cap space. This is in the US, we're not talking about junior miners or smaller oil and gas companies. How would you describe the space to myself, some of our listeners who are not that familiar with it?
So it's interesting from the Canadian point of view, because when people hear small or mid cap, they think about junior oil and gas or mining companies. That is not what we look at in the U.S. We have two mandates. One is the U.S. small mid cap, and even that has an average market cap of $9 billion U.S. Type company, and the bigger one, mid cap opportunities, has almost a $19 billion market cap. And these are companies with a history that either will do generate a lot of cash flows today or will in the near future. They are probably not household names, but that doesn't mean they are not leaders in their space. They're far from being an Apple who's in the headlines every day, but within their particular niches, they're well known.
Okay. I'm going to double down on that. You said they're well-known names, but the small mid-cap space would seem to me harder to research, to get information. Yet you and your team do that each and every day as you run the portfolio. So maybe this is the right time for you to take us into your research process. Maybe share with us how the team distills the information that you are seeking on companies and how that turns into names that actually make it into the portfolio.
So we start with, there's two sides, qualitative and quantitative, but we definitely start on a company with the top line growth. Can this company be a growth business down the road, growing faster than the economy, not just in it for a couple of years, but for many years to come? And that would be driven by the fact that the product or service is in demand because it's coherent with the way we see the world changing. So there's something about that product or service that's attractive to the customer, and they need or want more and more of it. And so that's where we begin. So it's not just a couple of years of growth, it's sustainable growth. And then do they do something that's difficult? So it's they get well paid for what they do, and that's reflected in the margins that they earn. If what they do is easy, then the margins would be low and it's less interesting to us. So it's something that's difficult to do because there's challenges, barriers to entry, trade secrets, intellectual property, that sort of thing. That's where we start.
Fascinating. And I'm going to ask you a question in a few minutes, but I might as well give you the heads up now because you've really piqued my interest by saying you like companies that do things that are difficult. So, before we end our conversation, I am going to ask, if not beg you, for an example of one of these companies and hear your stories. But first, I would love if you could tie in what you just shared with regard to the research process and tie it in with your overall investment philosophy because you're really looking at growth sectors from what I just heard. heard in the small and mid cap space. How does it kind of tie in with your philosophy?
So, when you are looking for growth that you can believe in for many years to come, that sort of, in our view, naturally gravitates you towards certain sectors. So that you will tend in these funds to see us own a lot of technology, a lot of healthcare, a lot of industrial, a little bit of consumer, maybe some financials. Probably not, if ever, see us doing much in the resources, materials, utilities, telecoms. That side of the boat is probably not where we are. We tend to end up.
While you focus your time on managing the portfolio, I'm spending my time each day on portfolio construction. I did notice the fund has material positions in tech, healthcare, industrials as well. Can you talk to me about these sectors and how they work, not just on their own, but with each other in a portfolio context?
It sounds kind of monolithic, so you're a tech and healthcare and industrials, team. That's all you do, and it's all on one, focused on one thing in each sector. If you look at the correlations, especially in technology and healthcare, the intra sector correlations of the stock performances, they are some of the least correlated. And that's because they are more driven by the unique characteristics of those businesses. But when you look at banks or resources, those are driven more. There is some uniqueness to each of those, but they are more driven by interest rates or commodity prices, that sort of thing. Within the sectors we invest in, it's much more driven by the idiosyncratic characteristics of those individual businesses. And you can choose to be in many different areas. For example, in technology, you could be a lot more cyclical. You could be in hardware, semiconductors, and you could be in semiconductors for consumers or industrials. You could be a lot less cyclical by being more of a software oriented investor, services oriented. Same thing in healthcare. You can go to hardware, life sciences tools. You can go to reagents and consumables. You can go to medical devices, clinical research organizations where outsourced clinical trials occur for the pharma companies. There's a lot of different areas to go. And we do from time to time alter our macro positioning. So when we see people very scared about the economy, we tend to get quite interested because we feel like those more cyclical businesses are less highly valued. And coincidentally, when everyone's thinking the economy's great and everything's booming, we probably get a little less cyclical. Those sectors also, although they sound like they're monolithic, they do provide us ways to alter our positioning too.
That's really interesting, Phil. Not only are they not monolithic, but correct me if I'm wrong, from how you described the sectors sound very different from how we would think about, or at least how I think about the sectors in the large cap space. Is that a fair comment on my part, or is it an overgeneralization?
Yeah, I think that's very true. You know, Something like an Amazon's great company. Everybody in the world uses probably Amazon for something, whether it's on the corporate side or the consumer side. Um, Within small and mid cap software, you could be, a business piece of software, a vertical piece that sells only to the construction industry, or you could be a horizontal piece that's a piece of essential, but a piece of the plumbing of, say, software development. So you can take a lot of different approaches within small and mid because there's very different orientations. Even in software, you could be vertical or horizontal. In semis, the same thing. You could be very consumer oriented or very business oriented.
That's really interesting, and I'm glad that you shared it because it certainly supports the case when we are building portfolios as investors to think about our allocation and what's the type of beta we want to have, what's the market exposures we want to have, and it certainly sounds within the U.S. small mid cap space you're getting very different exposures than what we would think or what we know we're getting in the large cap space. I do want to come back to that question that I gave you a heads up on because I am just quite curious. Your choice, but could you share an idea, a name, in the portfolio, past, present, that kind of really brings your approach and philosophy to life and also helps us better understand the small and mid cap space in the US?
A couple of weeks ago, because we've seen them recently, so it's of interest, we saw Cognex, which is actually a repurchase. So we've owned it in the past, but people got very optimistic about it, and we sold out of it. But now it's much less highly valued. Um, it's been through a recession. It's a machine vision company, so they provide hardware and software for people who want to automate processes. So they've been core to things like logistics, automotive, consumer electronics, semiconductors. I mentioned Amazon. Amazon's probably one of their key customers in their distribution warehouses. So that's of interest because they've been through a sort of a recession of their own as logistics pulled back and consumer electronics and automotive have been weak. Logistics has come back. We think the same will ultimately happen in some of their other core sectors like consumer electronics and automotive, ultimately. And at the same time, we think they will benefit if there is reshoring. The types of work that's brought back to the US or back to the developed world generally will be more automatable work. And Cognex plays a role there. They have a very strong share, especially in the US because they're a US company, a little less in Japan because one of their key competitors is there. But if someone does bring capacity to the US and manufacturing there, Cognex will probably be a beneficiary because it will probably be automated work. And at the same time, of interest is they have a whole new product line for small and mid-sized businesses, which they've never had before, but they've found a way to make their products, which were pretty complicated to implement in the past. They have a de-featured product line that's been especially driven by artificial intelligence, by AI, in which they have embedded a lot more knowledge in the product. And so to make it much more easier to implement and use by a small to mid-sized customer. So that is opening up a market for Cognex that they have never been in. So there's several drivers for this business that we see down the road. Right now, the market is very focused on the current softness in their business, but we see some great things ahead for this company.
What a fabulous example, Phil. Thank you so much. Follow up because you mentioned AI. I'm just curious. Are you seeing a lot of AI use cases for the companies, not just in the portfolio, but the companies kind of in your coverage universe and from the management teams that you speak to? Certainly, it was the theme du jour in the market in 2024.
Yeah.
But compelling use cases seem to be few and far between. But there seem to be more now. Are you coming across more and more?
One area we've always thought is of interest is information services. So people who collect and sell proprietary data that is difficult to get and that's unique. So think, we own, for example, CoStar in commercial real estate, um, Equifax in our big mandate for credit, consumer credit, medical device data like iRhythm in heart rhythm data that they've collected. So anybody who collects data that's unique and proprietary is a gold mine. So as we say, we don't own the mining equipment. That's Amazon, Google, Microsoft. They're going to implement probably a lot of the platforms for that stuff. But the actual data, a lot of our companies in their sectors do have a lot of that data. That's one area. And then people who are helping their customers with implementation of AI. For example, we mentioned EXL services a lot lately because agentic AI has become of interest to people, and EXL has a great actual practical example that's generating revenue today of an agent they've made for their insurance clients, in which they are very dominant, and which they have offered as a companion to their insurance agents, so that as they are having a conversation with a customer, the agentic AI can help that conversation along by showing, what the next steps should be, what the coverages are, all kinds of information to the agent that will help guide them in their conversation with the customer. So, companies are coming to people like services companies like EXL and saying, show me how I actually use this. And EXL is saying, well, here's one example.
Thank you so much for sharing that. It's so interesting. I wanted to, we talked, we've talked about the portfolio a couple questions ago. We talked about the sector allocations as well as the correlation. So I thought it was a good time to maybe move up a level and tie some of the things we've already talked about together. From your perspective, why is this maybe a good time to allocate to the small and mid cap space? Because I'm just thinking large caps have had up until recently a pretty good run the last 3 years. Why might this be the right time to allocate to U.S. small mid cap?
Well, there's no question that U.S. large caps have treated people very well, and that's great. They've had a great experience, but we do believe that ultimately, small and mid cap will recover. It's certainly underperformed. There's no question, but that's not going to last forever. Historically, it doesn't last forever. I can't tell exactly when that changes, but it will change at some point, and you want to be there when it does. So the idea of broadening out your exposure makes a lot of sense to me.
I like that. Now, Phil, I have one last question for you. You've been kind enough to share a specific stock idea. At the other end, we've talked about investment philosophy and investment approach. I even kicked the conversation off with an open-ended question that really had no answer, which is what's going to happen on the tariff front. In our wide-ranging conversation, I'm curious from your perspective, what have we not talked about that we have to make sure we leave our listeners with as we move to conclude our conversation? And if we've covered it all, what's the point that you want to make sure that we reiterate?
Well, one thing we do try to do is understand our businesses very well. So, if I do want to leave you with one thought, is that we spend all our day, as much as time as we can, studying the businesses we own, studying their cultures, studying the products or services and whether they're still of demand to the customers. And we spend time, yes, speaking to Wall Street and management, but we also speak to customers, ex-employees, competitors, channel partners. We try our hardest to really understand the environment in which our companies are functioning. So it's not just purely about just picking numbers off a list. It's about the companies.
That's amazing. I'm glad you shared that, and I'm glad you share the example of how you're having conversations with real people, not just the people at the company, but the customers and former employees and other stakeholders. That's great, and that is a great place for us to end our conversation. Phil, thank you very much for making the time to join the podcast, and I look forward to having you back sometime soon.
Sounds great. Thanks for having me.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.